Listed stocks or unlisted stocks? Which one should you choose? Where can you make more returns? What is more liquid, better in taxation? Where is the better risk? This is a common question people don't clearly know the answer to. So, what we're going to talk about today is a review of how the listed versus unlisted companies, how they have done in the last 15 years, what is a better strategy, what is a better approach, real life examples of what has happened with this or that in both cases, and what should you do depending on if you are a high risk, low risk, or a medium risk investor. This is what we're going to talk about in today's class. My name is Arpit Arora. I'm India's leading personal finance expert and passive income coach, and I'm on that quest to change the middle class of India and transform their financial life in such a way that they are able to have the potential to follow their passion. They have the focus to follow their passion. They are not distracted by money because they're creating enough passive income, and most importantly, they're able to live with inner peace and joy. And that, my friends, happens by winning the game of money. That happens when you upgrade your financial IQ, and that most importantly happens when you are committed to achieve financial freedom in your life. Because it cannot happen without a commitment, and it is my commitment to make sure you get all the support that you need to walk and achieve that destination. Listed stocks or unlisted stocks? Which one should you choose? Where can you make more returns? What is more liquid, better in taxation? Where is the better risk? This is a common question people don't clearly know the answer to. So, what we're going to talk about today is a review of how the listed versus unlisted companies, how they have done in the last 15 years, what is a better strategy, what is a better approach, real life examples of what has happened with this or that in both cases, and what should you do depending on if you are a high risk, low risk, or a medium risk investor. This is what we're going to talk about in today's class. So let's talk about listed companies and unlisted companies on different parameters. I want to talk to you about them in the context of risk, returns, liquidity, and taxation. Now, when it comes to risk, obviously the risk in unlisted companies is higher because these are companies, one, which are not under the purview of SEBI. So after getting listed, the SEBI's regulation makes sure the listed companies are better in at least governance, in under the surveillance of the norms that they have to follow, better auditing, and so many other things. The second thing is returns. Return is obviously very subjective, but returns के बारे में अभी मैं आपसे बात करूँगा. I'll talk to you about how the returns have been on both ends in the last 15 months. Taxes में obviously the listed investments are more efficient because the taxation is just 10% after 12 months into listed stocks and 15% in less than 12 months. But unlisted, you have to wait for 3 years before it becomes tax efficient. Otherwise, you have to pay tax as per your tax slab in the first 3 years itself. Most importantly, it is liquidity, because if you're able to make an investment, despite the investment has done well, if you're not able to book the profit of that, if there is not enough buyers in the market, if you can't sell it to someone else, just like the same problem that happens in real estate, value of the property gone up, but there is no buyer. So has the value of the property really gone up when you can't even book the profit? That is a common problem that also happens in unlisted shares. People claim to have, some people say they have made money, some people say they haven't made money. What is happening with the unlisted space is what I'm going to talk to you about. See, first thing I want you to understand that unlisted is not for everyone. If you don't have a corpus of 5-10 crores, don't even think about investing into unlisted space. That's the first thing. It could be a tool for diversification only for those who haven't already built up a big enough corpus where they can just experiment with 5-10 lakh rupees of investments in unlisted space. Now, here is what has happened with unlisted shares in the last few 15 months or so. One such prime example is the Reliance example. So this is the case of Reliance Retail. This buyback from Reliance Retail, RIL, has happened where people are not very happy about it because it's kind of a forced buyout from the corporate to the unlisted shareholders who actually bought the share at 3,000 where they are forced to sell their share at 1362 rupees back to RIL, who is now going to take all this money at almost 40% the price. So 60% का loss is what these people are going to forcefully book. Irrespective future में ये शेयर मान लो 4000, 5000, 6000 का भी हो जाएगा, but they will have to force sell at 1362. So a 60% loss is happening in this case. Another instance that we see here is, if you just actually look at this, you would understand that two other different companies apart from Reliance Retail, what we're sharing here is NSE, National Stock Exchange. This is one of the very, very common share that you would see that has gone up from 2950 rupees to 3150. So this is a journey of 200 rupees going up over almost 3000, which is, say, let's say 8%, 7%. That's nothing compared to what the markets has already delivered. And a similar thing you would say from CSK, which is Chennai Super Kings, another such situation where the share price has moved down from 215 to 167. So almost a 20% ka loss people are seeing on their investment. At the same time, what is happening in India, at least in the listed space, the purple line is Nifty 50, which has gone up tremendously in the last, since 2015 to now. You see 155% gain. If you look at it, in the last 2 years, it has again moved at least 15%. Wherein if you compare the similar returns of emerging markets, which is all the other emerging countries in the world, that index since 2015 to now has just given a 5% return. It is so evident to see that rather than investing in other emerging markets or unlisted space where people try to make more returns from their investment by taking a higher risk, what is less risky, Nifty 50, is delivering a way higher return with way more liquidity, with way better taxation, with way better risk. So the answer is very simple. As on current date, looking at long-term and also short-term experiences, it is always better to build your portfolio into ETFs, especially index ETFs. And once your corpus is big enough, then maybe you can consider investing for diversification into other ETFs outside of India, or going for unlisted shares. In that space, the quality of your research will be the most important factor which determines the quality of your results. The problem is most people are buying these shares because other people have bought it, or there are other financial guides or financial services people who are selling them this. And the reason why they sell this to them is because they get a higher margin. So if you don't have your own due diligence, your own research, and you're just buying this because people are coming and selling this to you, surely your results will be exactly what you see uh, in the research that I've shared with you. So be wise, be smart, do your own research, or have someone independently do this research for you. Then and only then expect to make more returns than what the market is already delivering. One thing that you should know is that Nifty 50 has delivered a 17.2% returns from 2000, 2003 May to 2023 May. So this is a 20-year period of 17.2% return. So if you cannot beat that, there's no point of investing anywhere else. Just stay invested in the indexes. Much better way, at least for people who are starting out or basic retail investors who don't do any research by themselves. I hope you're going to follow this as advice and apply this, and not fall into the traps of making quick money and eventually making either your money illiquid or losing return on your money. So be wise, invest wise.